The stock market, it's a place where fortunes are made and lost every single day. It can be exciting and terrifying all at the same time. We've all heard the stories, the rags to riches tales of everyday people becoming millionaires. But we also know the flip side, the stories of huge losses and financial ruin. So what is this mysterious beast we call the stock market? Let's break it down. Think of the stock market like a giant flea market, but instead of old lamps and vintage clothes, you're buying and selling pieces of companies. These pieces are called stocks, and owning a stock means you own a tiny slice of that company. Pretty cool, right? But here's the thing. The value of these stocks can go up or down, sometimes drastically. That's where the risk and the reward come in. If you buy a stock and its value goes up, you make money. If it goes down, well, you lose money. It's a lot like gambling, but with the potential to grow your wealth over the long term. So, what exactly are you buying when you buy a stock? You're buying a small piece of ownership in a publicly traded company. That means the company has decided to sell pieces of itself to the public to raise money. When you buy stock, you become a shareholder, also known as an investor. As a shareholder, you have the right to vote on certain company matters. You also have the potential to earn money if the company does well and its stock price goes up. Of course, the opposite is also true. If the company performs poorly and its stock price falls, you could lose money. That's why it's so important to do your research before investing in any stock. You need to understand the company, its business model, and its potential for growth. Don't just buy something because you heard it was a hot tip. The stock market operates through a network of exchanges, like the New York Stock Exchange or the Nasdaq. These exchanges are like giant auction houses where buyers and sellers come together to trade stocks. But instead of yelling out bids, they use computers to place orders. Brokers act as intermediaries between you and the exchanges. You tell your broker what stock you want to buy or sell, and they execute the trade on your behalf. The price of a stock fluctuates throughout the day based on supply and demand. If more people want to buy a stock than sell it, the price will go up. If more people want to sell than buy, the price will go down. It's all about supply and demand, just like any other market. The more people want something, the more valuable it becomes. And the less people want something, the less valuable it becomes. Section 4, From Tulips to Tech Stocks. The stock market has a fascinating history dating back to the early 17th century in Amsterdam. Believe it or not, one of the earliest examples of a stock market involved tulip bulbs. People were buying and selling these bulbs like crazy, driving up their prices to astronomical levels. This period, known as tulip mania, is a cautionary tale about the dangers of speculation and market bubbles. Over time, stock markets emerged in London and Paris, laying the groundwork for the modern exchanges we know today. In 1792, the New York Stock Exchange was founded, which would become one of the most important financial institutions in the world. The stock market has weathered many storms throughout its history, including the Great Depression in 1929 and the dot-com bubble in the late 1990s. These events highlight the cyclical nature of the market and the importance of long-term investing. The market goes up, the market goes down, but over the long haul, it tends to trend upwards. Section 5. The engine of the economy. The stock market plays a vital role in the economy. It provides companies with access to capital, allowing them to grow and create jobs. When you buy stock in a company, you're essentially giving them money to invest in new products, hire more employees, and expand their operations. This, in turn, helps to boost economic growth. For investors, the stock market offers the potential to grow their wealth over time. By investing in companies that are well managed and have strong growth prospects, you can participate in their success. Of course, investing in the stock market is not without its risks. As we've seen throughout history, the market can be volatile, and there's always the potential for loss. That's why it's crucial to diversify your investments, invest for the long term, and never invest more than you can afford to lose. Remember, the stock market is a marathon, not a sprint.